The first balance does not feel like a system. Not at first. It feels like an email, a number on a screen, a small, ordinary moment that arrives before the day has really started. You were young enough to tell yourself this is normal, but old enough to understand that the number matters. Student loans, a credit card you opened because everyone around you seemed to have one, a laptop you did not buy all at once because the monthly payment felt easier to carry than the full price. None of it looked dangerous when it entered your life. Each piece had a reason. School was an investment. The card was for building credit. The laptop was necessary. The payment plan made the cost feel manageable. And maybe all of that is true. That is what makes the first level so difficult to see clearly. Debt does not always enter your life looking like a mistake. Sometimes it arrives looking responsible. Sometimes it arrives with paperwork, approval language, student portals, clean apps, small monthly numbers, and the quiet feeling that this is just what adulthood costs. Sometimes debt arrives dressed as adulthood. So you tell yourself, this is how people begin. Everyone starts somewhere. Everyone has loans. Everyone carries a balance for a while. Everyone pays a little interest before life becomes more stable. The thought is comforting because it gives you permission to keep moving. You go to work, you answer emails, you sit in a place you do not own, using income you have not fully received yet to pay for obligations you accepted before you understood how long they would follow you. At first, the debt looks manageable. Not because it is small, because the system gives it a shape you can live with. A minimum payment, a due date, a monthly statement, a number low enough to fit inside the paycheck, but high enough to keep the balance alive. That is the quiet design of this level. The payment does not need to solve the debt. It only needs to make the debt feel survivable. So you pay what is required, you feel responsible for a moment, the account stays current, nothing collapses, no one calls. No warning appears. And because there is no immediate crisis, you begin to mistake motion for progress. The number moved, a payment posted, the system accepted it, so it feels like you are handling it. But while you are working, the debt is working too. Interest does not wait for you to understand it. It does not ask whether this was a good month. It does not care whether you were tired, underpaid, optimistic, distracted, or simply doing what people around you said was normal. It moves quietly, in the background, while you sleep, while you commute, while you sit at lunch telling yourself that once income rises, everything will become easier. This is the first hidden cost. Debt begins as a number you owe, but very quickly it becomes a claim on your future behavior, a claim on the next paycheck, a claim on the raise you have not received yet, a claim on the month you thought would finally give you room. You do not feel this all at once. At this level, debt still feels personal, almost private, a balance between you and a lender. You think the problem is the amount. If the number were smaller, you would feel better. If the interest rate were lower, you would breathe easier. If the next paycheck were larger, you could finally get ahead. And some of that is true, but it is not the whole truth. Because debt is not only a balance, it is a claim. At the lowest level, it claims income before that income has a chance to become freedom. Later, it can claim choices, then time, then cash flow, then a company's strategy, then ownership, then policy. And at the highest levels, debt becomes part of how the future itself is priced. But you do not know that yet. Right now, you only know the first version, the version that fits inside a login screen, the version that makes you check the account twice, even though the number has not changed in a way you can control. the version that lets you feel responsible and trapped at the same time. That is the emotional truth of the consumer debtor. You are not stupid. You are not uniquely careless. You are standing at the first level of a much larger structure. And at this level, the structure is designed to feel normal. The ceiling is simple. You can make the payment. You can stay current. You can avoid disaster. But staying current is not the same as being free. The debt still owns part of the next decision before you make it. And once the balance becomes large enough to look like stability from the outside, debt stops being just something you pay. It starts deciding what you can risk. Level 2, the obligated middle class. This level does not look like failure. That is what makes it harder to recognize. From the outside, it looks like progress. You have a stable job now, a better title, a car payment that fits inside the month, a mortgage or a rent payment large enough to make your life feel settled. Maybe a home equity line sitting quietly in the background, available if something expensive happens. Your income is higher than it used to be. Your account is not empty every week. People around you may even describe your life as responsible. And in many ways, it is. You are not reckless. You are not lost. You are doing what the structure told you adulthood should look like. You have become easier to approve, easier to evaluate, easier to place inside the ordinary picture of a person doing well. But inside that picture, something has changed. Debt is no longer just a balance you check. It has become part of the architecture of your behavior. It decides more than you admit. You think about leaving your job, and the mortgage answers before you do. You think about moving to another city, and the car note, the rent, the rate, and the monthly obligations enter the room. You think about starting something on your own, and the numbers become serious very quickly. Not because you lack courage, not because you lack ambition, but because debt has already placed claims on the months ahead. At this level, the debt does not need to threaten you. It does not need to call. It does not need to become dramatic. It only needs to be due. On the 1st. On the 15th. Every month. Quietly. Reliably. Without caring whether the job still fits you. Without caring whether the manager respects you. Without caring whether the city still makes sense. Without caring whether the life you built around the payments has become too small. This is the emotional truth of the obligated middle class. You look stable, but your optionality has narrowed. You can afford the life, but you cannot easily move inside it. The house, the car, the credit line, the steady income, all of it can look like success from the outside. But underneath, debt begins to behave like a silent manager. It does not sit in an office. It does not review your performance. It does not ask you to stay late. But it shapes what you are willing to risk. It shapes which conversations you avoid. It shapes how much disrespect you tolerate. It shapes how long you wait before changing direction. And over time, you may learn to call that maturity. You tell yourself it is responsible to stay, responsible to wait, responsible to postpone the thing you wanted to try. Sometimes it is. Sometimes patience is wisdom. Sometimes stability is worth protecting. But sometimes the debt is making the decision before you get to make it. That is the limit of this level. You may have built a life that looks stable, but some of that stability is rented from the future. The payments make the life possible. And the life makes the payments necessary. That loop can become quiet enough to feel normal. And once obligation becomes large enough, debt stops being something you simply pay. It becomes something you consult before making a move. That is where the next level begins. Level 3, the personally guaranteed business owner. At first, this level feels like escape. You are no longer only working inside someone else's system. You have a business now, a lease, a lender, a few customers, maybe employees who depend on the schedule you create, maybe a storefront, a small office, a commercial space, or a service business that finally feels real enough to have fixed costs. From the outside, this looks like freedom. You work for yourself. You make the decisions. You are not waiting for permission in the same way. There is no manager standing over the calendar, no company handbook telling you exactly where your day belongs, no corporate title defining the edge of your usefulness. But very quickly, you learn that leaving an employer does not mean leaving obligation. It only changes the address where obligation finds you. The lender has a claim, the landlord has a claim, payroll has a claim. Vendors have claims, taxes have claims, the software bill, the insurance policy, the equipment payment, the line of credit. Each one has a date attached to it. And the business does not care how tired you are. It does not pause because you worked late. It does not soften because you took the risk. It does not congratulate you for trying. At this level, cash flow becomes the real boss. Profit on paper is not enough. A strong month is not enough if the money arrives too late. A signed contract is not cash. An unpaid invoice does not cover payroll. A client who promises to pay next week cannot stop the payment due this Friday. You begin to understand timing in a way you never had to before. Not as a concept, as pressure in the body. You check the account before you check your messages. You know which receivables need to clear. You know which bill can wait 2 days and which one cannot. You know what happens if one customer delays, one payment processor holds funds, one repair appears, one slow week lands at the wrong time? And if there's a personal guarantee, the wall between the business and your life is thinner than it looks. If the business fails, the debt may not stay inside the business. It can follow you home. That changes the weight of every decision. You are free in one sense, but exposed in another. The hidden cost of business debt is that it turns time into obligation. Every quiet day costs money. Every delayed payment has a shape. Every hour that does not produce revenue still sits inside a structure that expects to be fed. You may tell people you work for yourself, and that is true. But there are mornings when it feels more accurate to say you work for the cash flow, for the lender, for the payroll date, for the rent, for the obligations that arrive whether the month was good or not. This is not the same as personal debt. Personal debt constrains behavior. Business debt weaponizes time. It can create opportunity. It can help build something real. It can turn an idea into a location, a team, a product, a service, a business that would not have existed without borrowed capital. But it also forces every day to answer a financial question. Can the business carry what it borrowed? And can you carry what you personally guaranteed? That is why this level is not the top. You have moved from being constrained by debt to operating inside debt. But the pressure is still close to your body, still close to your sleep, still close to your home. When debt becomes large enough to move through a company instead of one person, the fear does not disappear. It becomes professional, measured, modeled, and presented in cleaner language. Level 4, the corporate debt operator. At this level, debt no longer sits so close to your personal life. It does not appear as a credit card balance on your phone. It does not follow you home through a personal guarantee in quite the same way. It does not wake you up because one client paid late and payroll is due tomorrow. Now the numbers are larger. The language is cleaner. The pressure has moved into spreadsheets, lender calls, quarterly reports, and board decks that make danger look organized. You may sit inside a finance department now. Maybe you manage treasury. Maybe you are the person responsible for knowing whether the company can move through the next quarter without anyone outside the room realizing how tight the structure has become. At this level, debt becomes corporate. But corporate does not mean emotionless. It means the emotion has been translated. Fear becomes a downside scenario. A cash problem becomes a liquidity event. Survival becomes runway. Pressure becomes covenant headroom. Anxiety goes into Excel. You monitor the numbers that decide how safe the company really is, how much cash remains, how much debt has already been drawn, how close the company is to the lender's limit, how much revenue can fall before the structure begins to tighten. These questions sound technical. They sound like finance language. They sound like the kind of thing that belongs in a controlled meeting with bottled water, clean slides, and people who know how to speak calmly about risk. But underneath them are human consequences. If liquidity gets too thin, payroll becomes a question. Vendors may wait longer. Hiring may freeze. A department may be cut. A project may disappear before anyone outside the room ever learns why. The numbers do not stay numbers for long. They move downward into people's calendars, into workloads, into paychecks, into job security, into the quiet pressure that appears in a company before anyone announces that pressure exists. This is the strange calm of corporate debt. No one is shouting. No one says panic. The meeting is professional, the slide deck is clean, the assumptions are organized, the language is careful. But everyone who understands the model knows what certain lines mean. A covenant breach is not just a technical violation. It can change who has power in the room. It can give lenders the right to demand faster repayment. It can force a company to refinance when it has the least leverage. It can turn a slow problem into an immediate one. So you manage distance. Distance from default. Distance from a cash shortfall. Distance from the point where lenders stop asking questions and start making decisions. At this level, debt is no longer only something owed. It becomes something operated. You use refinancing to buy time. You move short-term pressure into a longer timeline. You accept a higher cost if it keeps the company alive long enough to adjust. From the outside, this can be described as improved capital structure. It sounds clean, almost strategic. Inside the room, it feels more direct. You bought months. You protected payroll. You kept vendors calm. You gave management one more chance to make the business work. But time bought with debt is still bought. It has a price. And that is the hidden cost of this level. The company may survive, but it survives inside conditions. Lenders do not control the business every day. They do not walk the floors. They do not manage the team. They do not sit with the employees who wonder why budgets have become tighter. But they define the walls of the room. They define what can be done before approval is needed. They define how close the company can get to the edge before the conversation changes. That is why this level is not the top. You have moved beyond being controlled by debt personally. You now operate debt professionally. You understand it with more precision. You can name the pressure before it becomes visible. You can model the problem before it becomes public. But you are still downstream from the people who decide how debt can be used to buy control itself. That is where the next level begins. Level 5, the leveraged buyer. At this level, debt is no longer used mainly to survive a difficult period. It is not only used to smooth cash flow, not only to extend runway, not only to keep a company from breaking under timing pressure. Now debt is used to acquire, to control, to change ownership without using only your own capital. A company is studied, its cash flows are modeled, its management team is evaluated, its cost structure is reviewed, its future is placed into a spreadsheet before most people inside the company know their future is being discussed. The deal is built in layers, some equity, a larger amount of debt, different lenders, different claims, different levels of risk, different rights if things go wrong. But the basic mechanism is quiet and powerful. Borrowed money helps buy the company, then the company itself has to carry much of the weight. That is the shift. The person arranging the deal does not feel the pressure in the same way the company will feel it. The fund sees leverage. The lenders see repayment capacity. The investors see returns. Management sees targets. Employees feel the pressure in schedules, headcount, budgets, and expectations that become tighter without always being explained in those words. At this level, the language becomes very clean. Efficiency, margin improvement, capital discipline, operational focus, value creation. None of these phrases sound violent, none of them sound emotional, none of them sound like a person wondering why the team is smaller, why the workload is heavier, or why every department suddenly has to justify itself again. That is part of the power of the language. It makes pressure sound rational. It makes extraction sound organized. It makes debt feel like a tool, not a weight. And from above, it often is a tool. Used well, leverage can make an acquisition possible. It can sharpen discipline. It can force lazy capital to become active. It can create returns for investors whose money may come from pension funds, endowments, institutions, and people who will never meet the workers inside the company. But from below, the same structure feels different. The payment schedule does not care about morale. The lender does not measure exhaustion. The model does not always show what happens to a warehouse, a clinic, a software team, or a regional office when pressure becomes permanent. It does not always show the manager who has to explain a cut without explaining the full structure behind it. It does not always show the employee who feels the pace change before anyone says the word leverage. This is the emotional truth of the leveraged buyer. The more often you see the pattern, the less direct it feels. The first restructuring may stay with you. The second becomes a case. The third becomes a line in performance reporting. Not because you are evil, because the level trains you to see distance instead of proximity. Returns go upward. Pressure moves downward. And the space between those two movements becomes easier to live with if you stop staring at it too long. That is the hidden cost. Leverage separates the person who benefits from the place where pressure lands. What looks like efficiency from above can feel like compression from below. What looks like capital discipline in a memo can feel like fewer people doing more work inside the company. This is why the level is powerful, and also why it is not the top. Because once you understand that debt can buy control, the next level asks a colder question. What happens when you do not buy the company, but you buy the claim it can no longer escape? Level 6, the distressed creditor. At this level, debt is no longer something you use to buy a company. It is something you buy after a company has already weakened. You are not there at the beginning. You did not rent the first office. You did not hire the first employee. You did not build the culture, carry the early losses, or sit through the years when the business was still trying to become real. You arrive later, after the optimism has thinned, after the margins have tightened, after the lenders have grown impatient, after the balance sheet has started telling a story the founder does not want to hear. The company may still be operating, people still come to work, customers still pay, the logo is still on the building, the the phones still ring. The website still works. Invoices still move. From the outside, it may not yet look like the future has changed, but underneath, the capital structure has changed the meaning of everything. At this level, you buy debt that other people no longer want to hold. A bank sells because it wants risk off its books. A fund sells because the position no longer fits its mandate. Another investor sells because the price has fallen too far and the uncertainty has become too heavy. The company calls it a difficult period. You call it an entry point. That is the difference. You are not buying the business in the ordinary sense. You are buying the claim. And if the claim is senior enough, if it sits high enough in the capital stack, it can become more powerful than ownership itself. This is the cold logic of distressed debt. Control does not always come from building. Sometimes it comes from holding the obligation no one else can ignore. You may sit across from a founder who spent 20 years building the company. They know the customers. They know the employees. They know the history inside the walls. They remember the first order, the first office, the first year the business almost failed and somehow survived. They remember decisions that never appear in a restructuring model. They remember names, not just departments. They remember what the company meant before it became a case file. But in that room, memory is not the strongest force. The strongest force is the claim. Who gets paid first? Who can block the plan? Who can approve the restructuring? Who can decide what survives, what is sold, what is closed, and who remains? The emotional truth of this level is difficult because everything looks clean on paper. There are documents, priorities, recovery values, legal processes, restructuring plans. You can tell yourself you are not destroying the company. You are converting it from one form of ownership to another, from a failed structure to a more viable one. And sometimes that is true. A business can survive through restructuring. Jobs can remain because creditors agree to a new shape. A company that would have disappeared can continue under different terms, but the hidden cost remains. You can gain control over something you did not create because you hold the claim that becomes unavoidable when the old structure breaks. That is not unusual. That is not outside the system. It is one of the ways the system works. But it changes the distance between creation and control. The person who built the company may still be in the room, but the future now belongs to whoever can determine the terms. That is why this level is not the top, because a claim on a company is powerful. But a claim can move higher than one business, higher than one management team, higher than one group of employees. It can move into the structure of a country. That is where the next level begins. Level 7. The sovereign debt negotiator. At this level, the room becomes quieter. The language becomes cleaner. The consequences become larger. You are no longer discussing one company's debt. You are discussing a country's ability to keep functioning under obligations it can no longer carry in the old form. There is a finance ministry. There are bondholders. There are banks. There may be an international institution in the room, or just outside it. There are advisors on both sides. There are documents that turn pressure into policy language. Debt to GDP, fiscal adjustment, currency pressure, primary surplus, debt sustainability. Each phrase sounds technical, almost neutral, but none of it stays on the page. When subsidies are removed, someone pays more for fuel. When austerity begins, a clinic may have fewer supplies. A school may wait longer for funding. A public worker may see wages frozen. When a currency weakens, imported food, medicine, equipment, and energy become more expensive. When state assets are privatized, something that once belonged to the public begins moving under a different set of incentives. This is where debt becomes policy through obligation. No one says it that directly. The press release will not sound like that. It will speak about stability, confidence, market access, reform, sustainability. And some of those words may be necessary. A country that cannot borrow, cannot import, cannot stabilize its currency, and cannot pay essential obligations faces its own kind of crisis. There are no clean choices here. That is what makes the level heavy. You can understand why restructuring is necessary. You can understand why creditors want terms. You can understand why institutions demand conditions before new money arrives. And still, you can know that the people living inside those conditions were not sitting at the table. They will feel the negotiation later, not as a term sheet, as a bus fare, as an electricity bill, as a higher grocery total, as a closed program, as a job market that tightens, as a future that becomes narrower in ways that never mention the word bond. The emotional truth of this level is that the language stays professional because it has to. If every sentence carried every human consequence, the room might not function. So the language creates distance. It allows people to negotiate without bringing every household into every paragraph. But distance does not erase the result. It only makes the result easier to administer. The hidden cost is influence without electoral accountability. Creditors are not elected. Bondholders do not campaign in the country whose budget is being reshaped. Advisors do not live under every condition they help draft. And yet, debt gives them a seat in choices that look political from the outside, but financial from inside the room. That is the structural insight of this level. Debt no longer follows politics. It shapes the choices politics is allowed to make. A government may still announce the policy. A minister may still defend it. A parliament may still debate it. But the range of available choices has already been narrowed by the obligation, by the market, by the creditors, by the cost of refinancing, by the need to restore confidence from people who will never stand in line at the hospital, ride the bus, or buy food with the local currency after it falls. This is not a simple villain story. It is heavier than that. Some countries borrowed badly. Some lenders underwrote knowingly. Some governments delayed hard decisions. Some creditors demanded too much. Some reforms were necessary. Some costs were pushed onto people least able to absorb them. The system contains all of this at once, and that is why this level is not the top. Because even sovereign negotiations are still individual cases. One country, one restructuring, one set of creditors, one set of terms. Above that is a quieter layer, where the real power is not negotiating one debt, but helping decide what debt costs everywhere. Level 8, the Global Liquidity Architect. At this level, debt no longer belongs to one person, one company, or one country. It becomes part of the environment. The air inside the financial system, the thing every bank, government, corporation, and household moves through, whether they can see it or not. You do not need to look rich at this level. You do not need a public name that ordinary people recognize. You may not directly own the capital being moved. You may not manage a portfolio anymore. You may not sit in front of a screen watching prices move all day. The work is quieter than that now. You understand flows, you understand access, you understand which institutions need liquidity, which markets are becoming fragile, which borrowers can raise money easily, and which borrowers will be punished by the price of capital. You understand where pressure is building before it becomes visible. You understand which door closes first when money becomes more expensive. You understand who will feel the cost immediately and who will not feel it until months later when the explanation has changed names. At this level, power does not always look like ownership. It looks like proximity to the conditions that make ownership possible. The cost of capital, the availability of credit, the price of risk, the rules banks use before they lend, the confidence that allows a bond issue to clear. The quiet signals that tell markets whether money will remain easy, become tighter, or begin moving somewhere else. Most people will never see this layer directly. They will feel it later. Not in the room where the decision is discussed. Not in the language used by institutions. They will feel it in a mortgage rate that no longer feels affordable, in a credit card rate that adjusts upward, in a company that slows hiring, in rent that rises because financing costs moved first. In a layoff explained as discipline, efficiency, or market conditions. In a small business that cannot refinance at the old rate. The signal moves first, the explanation arrives later. And the people at the bottom usually meet the result long after the structure has already shifted. That is the emotional truth of this level. Power becomes quiet, distant, almost administrative. You do not need to force anyone directly. You do not need to own every asset. You do not need to appear as the face of a decision. You only need to understand how capital moves, who can access it, what it costs, and where pressure will land when the price changes. But this level has a cost. Power without visibility often becomes life without ordinary closeness. The calls are limited. The language is guarded. The relationships become filtered through discretion, confidentiality, and usefulness. You know things you cannot explain casually. You understand consequences before they become public. You learn to speak in careful sentences because the wrong sentence can move people, prices, or policy. The higher you move, the less the world can understand what you actually do. And the less you can return to the simplicity of not knowing. That is the hidden cost. At the bottom, debt takes your choices. At the top, debt gives you influence. But influence has its own form of isolation. You are no longer asking how to escape the system. You are helping shape the conditions inside it. And that is why this is the highest level. Not because you owe the most, not because you own the most debt, not because you sit on the largest balance sheet, but because you are close to the place where debt becomes price, where price becomes access, where access becomes behavior, and where behavior becomes the shape of the economy that everyone else has to live inside. That is the final inversion. The first balance was never only yours. When you were young and staring at a number on a screen, it felt personal. It felt like your student loan, your credit card, your monthly payment, your mistake, your responsibility, your private burden. And in one sense, it was. You had to pay it, you had to manage it, you had to live with the pressure of it. But the deeper truth is that the balance was only the first visible point of contact. The system was already around you. The company you worked for may have been financed with debt. The building you sat in may have been purchased with borrowed capital. The bank holding your account may have been lending far beyond the cash it physically held. The currency in your account was itself a promise backed by a government with its own obligations. The interest rate on your card was connected to decisions made far above your personal life. The rent you paid, the job market you entered, the cost of a car loan, the price of a home, the pressure inside companies, the budget of governments, all of it was touched by the same architecture. You thought you were looking at a balance, but you were touching a system. And as you move through every level of debt, the question changes. At first, the question is, how much do I owe? Then, what does this debt make me do? Then, what does this debt prevent me from risking? Then, how does debt control time? Then, how does it shape a company? Then, how does it transfer ownership? Then, how does it narrow policy? And finally, who helps decide what debt costs for everyone else? That is the architecture behind the balance. Debt is not one thing. It is a relationship, a claim, a tool, a constraint, a mechanism, a price, a form of power. At the bottom, it can quietly take your future before you understand the terms. In the middle, it can discipline your behavior and narrow your options. At the top, it can buy control, restructure institutions, and influence the choices of governments. And above that, it becomes part of the machinery that decides how expensive the future will be. The point is not to fear every debt, and it is not to admire every person who uses it. The point is to understand where you stand inside the structure, whether debt is controlling you, serving you, moving through you, or being used by someone else to control something larger. Because the system does not need you to understand it in order to operate, it will keep moving, quietly, constantly, through balances, payments, rates, claims, policies, and prices. But once you see the structure, the number on the screen is no longer just a number. It is a doorway. And what you do next begins with knowing which side of the claim you are standing on.